This week in markets, US inflation holds steady but stays stubborn. Europe braces for high rates well into 2026, and Ukraine's biggest mobile operator makes history with a Nasdaq listing. Let's break it all down. On August 12th, we got the July Consumer Price Index, and the numbers came in stable but sticky. Inflation rose 2.7% year over year, exactly the same as June. Month over month, prices were up 0.2%, slightly slower than June's 0.3%. And that was actually better than most forecasts. Analysts expected 2.8% annually. That little surprise gave investors confidence boost. But here's the catch. Core inflation, that's without food and energy, ticked higher, up 0.3% for the month and 3.1% for the year. That's above both June's numbers and expectations. And it tells us the Federal Reserve's 2% target is still out of reach. Markets like the headline CPI numbers. On August 13th, the Dow jumped 1%, the S&P 500 rose 0.32%, and the Nasdaq added 0.14%. Part of the optimism also came from renewed progress in US-India trade talk, but the celebration didn't last long. On August 14th, the Producer Price Index, that's wholesale prices, came in hot, up 0.9% for the month and 3.3% year over year. And that's where the concern kicked in. Higher producer prices today often mean higher consumer prices tomorrow. So here's the takeaway. Disinflation is happening. It's uneven. CPI isn't accelerating, but it's not falling fast enough either. Investors have been betting with over 90% probability that the Fed will cut rates by year's end. But with sticky core inflation and a surprise PPI jump, that call is looking riskier. Rate-sensitive sectors like real estate and tech could see more volatility. For consumers, it means purchasing power is still under pressure, especially in housing, transport, and services. Businesses, particularly smaller ones, are getting squeezed on costs and can't always pass those costs to customers. Over in Europe, the story is a bit different, but the conclusion is similar. Rates are staying high. Markets now expect the first ECB rate cut in March 2026, later than before. That's thanks to reduced deflation fears after US-EU trade deal and optimism over Germany's spending plan. For investors, this means European banks could keep benefiting from higher lending margins. Bond investors, though, may need to wait longer for price gains and may prefer shorter maturities for now. For businesses, borrowing stays expensive, which could slow investment, especially in real estate and construction. And finally, a historic move from Ukraine's largest mobile operator, Kyivstar. On August 14th, they announced they'll debut on the Nasdaq on August 15th, the first Ukrainian company to do so. Kyivstar serves over 24 million subscribers, is owned by Dutch-based VEON, and is looking to raise funds for rebuilding infrastructure and expanding digital services after the war's damage. This IPO is also highly geopolitical. Former US Secretary of State Mike Pompeo is on their board, and they've partnered with Elon Musk's Starlink to boost satellite connectivity. If the IPO does well, it could unlock more international investment for Ukraine's infrastructure, energy, and digital sectors. But of course, it comes with risks, from geopolitical tensions to energy stability. So here's where we stand. In the US, inflation progress is slowing. In Europe, the ECB is in no rush to cut, and in Ukraine, a Nasdaq debut could open the door for more post-war investment. It's a tricky environment, part optimism, part caution. And for investors, that means one thing: be selective, manage your risk, and watch the data closely in the weeks ahead. Thank you so much for watching. Let's build the bridges and not burn them. Goodbye.